In 2009, a single provision buried inside a routine Senate vote would have capped your credit card interest rate at 15% forever. It failed by 33 votes. The senators who killed it had collected between them $130 million from the banking industry in the decade before that vote, and none of them were required to say so out loud. The year is 2009. The country is still pulling itself out of the worst financial collapse since 1929. Banks had taken the bailout money, $700 billion of it, and were still charging their customers 29% interest. Congress was angry. The public was angrier. So lawmakers drafted something called the Credit Card Accountability, Responsibility, and Disclosure Act. The Card Act. It was supposed to fix everything. It banned certain fees. It required clearer billing statements. It protected young people from predatory sign-up offers on college campuses. On paper, it looked like the most significant consumer protection legislation in a generation. And most of America never heard about the part that didn't make it in. Senator Bernie Sanders introduced an amendment. Simple, direct. No credit card company operating in the United States would be allowed to charge more than 15% interest. That was it. No loopholes. No exceptions carved out for certain products or certain customers. A hard ceiling. At the time, the average credit card rate was sitting at 14.9%. So the amendment would have locked in what most Americans were already paying and prevented banks from ever going above it. 230 million credit card accounts. Locked, protected. The vote came on May 12, 2009. 60 senators voted no. 33 voted yes. And with those 60 votes, the amendment was stripped from the bill before it ever reached the president's desk. The Card Act passed anyway. It went into law. It was celebrated. And the 15% cap was never mentioned in the press conference. The official story was simple. Capping interest rates would hurt credit availability. Banks would stop lending to risky borrowers. Low-income Americans would lose access to credit entirely. That was the argument made on the Senate floor. And it sounds reasonable until you check what actually happened. In the 3 years following the Card Act, credit card interest rates rose from an average of 14.9% to over 20%. The banks that lobbied hardest against the cap, Citibank, J.P. Morgan Chase, Bank of America, reported combined credit card revenues of $43 billion in 2011 alone. The credit wasn't restricted. The rates climbed anyway. And the people who had argued the cap would harm borrowers said nothing about the climb. Now watch what happens next. Because the number that should stop you is $130 million. That is the combined amount the 60 senators who voted against the cap received in financial industry contributions in the 10 years before that vote, according to campaign finance disclosures compiled by the Center for Responsive Politics. Some senators received relatively modest amounts. Others received significantly more. The top recipient among the no votes had taken in over $4 million from banking and credit interests before casting that vote. None of this was hidden exactly. Campaign finance disclosures are public, but they are complicated, spread across multiple databases, reported in different formats, and not typically summarized side by side with a specific Senate vote on a specific day. Someone would have to look, and almost no one did. Here is the part that makes it impossible to dismiss. This was not the first time. In 1991, a similar amendment to cap credit card rates at 14% passed the Senate 74-19. It passed, overwhelmingly, and then it was quietly removed in a House-Senate Conference Committee, a closed-door reconciliation process, before the final bill was signed. The cap that 74 senators voted for never became law. That was 1991. In 2009, they didn't even let it pass first. Consider what a 15% cap would mean today. The average American carries a credit card balance of $6,501. At 20% interest, they pay roughly $1,300 in interest per year on that balance. At 15%, they pay $975. The difference is $325 per year per person. Multiply that across 160 million Americans carrying balances, and the number approaches $52 billion annually, transferred quietly from cardholders to the financial industry every year. That money doesn't disappear. It goes somewhere. It goes into bank earnings reports. It goes into executive compensation. It goes into lobbying budgets that fund the next round of campaign contributions. The cycle doesn't stop. It doesn't even slow. And the mechanism that could have interrupted it, that 15% amendment, was killed in 2009 and has never been reintroduced in exactly the same form. So here is the question no one on that Senate floor answered. If capping interest at 15% would have hurt borrowers, if that was truly the reason 60 votes went the other way, then why did rates go up after the cap was killed? Who exactly was protected by that no vote? And why has no one asked them directly?